In the month of March, my portfolio jumped like a kangaroo on a trampoline, with a few of my holdings even seeing double-digit gains. However, like Rocky says, it ain't all sunshine and rainbows, and a few of my stocks took some pretty big losses, which gave me an opportunity to pick up one of my favorite dividend stocks at a discount, which I'll be telling you more about in this month's portfolio update. But first, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, leave me a comment below and let me know which stocks you bought in the last month. I'd be curious to hear what you've been adding to your portfolio. Anyway, taking a look at my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to it in the description of this video. I hope you check it out. But looking at this, my portfolio's current market value is $44,478.09, which according to Charles Schwab means that my portfolio gained about $875 just in the month of March. So it was a pretty good month for me. And taking a look at how this gain was broken down, it came from two different sources. We've got investment gain and loss right here, which is essentially share price appreciation. And in total, across my entire portfolio, my stocks appreciated by near $730. So most of this is coming from share price growth. And then in the month of March, I brought in nearly $150 of dividend income. So that plus that equals this total investment change right here. But anyway, guys, speaking in terms of percentages, this means that my portfolio jumped up nearly 2% just in the month of March, which is much better than last month's performance, where I was down almost 3%. And taking a look at how this compares to the three major indices, the S&P, the Dow Jones, and the NASDAQ, my portfolio is underperforming all three, not by too much. I mean, I'm right there with the Dow, not too far behind it, but the S&P and the NASDAQ just crushed my portfolio in the month of March. And taking a look at this on a year-to-date basis, so far in 2023, my portfolio is up about 1.5%, so I am beating the Dow here, but once again, the S&P and the NASDAQ are just crushing me right now. The NASDAQ is up almost 17% year-to-date. That's pretty crazy. But then if we zoom out once again, taking a look at a longer period of time across the last year, we'll see that my portfolio is actually still technically beating the market. Here I am in the red, down almost 2%, but this is seeing less of a drawdown than the three major indices. In the last year, the S&P is down 8%, the Dow Jones down nearly 2.4%, and then the NASDAQ still down quite a bit, 14.3%. And then going back over to my spreadsheet here, guys, taking a look at my annual dividend income, this is currently sitting at $1,973, which means on average, I'm bringing in almost $165 every single month, and this represents about a $34 gain compared to where my annual dividend income was sitting this time last month, where I was bringing in about $1,940. And where I'm at now officially puts me back over where I was before Intel cut their dividend, which if you recall in last month's portfolio update took me from $1,969 down to the starting point in the month of March, that $1,939. So with Intel's dividend cut, I lost about $30. And I'd be willing to bet that by next month's portfolio update at the beginning of May, this portfolio will be officially over $2,000 of annual dividend income, which is a really cool milestone. I've been waiting for this one for quite some time, and I think this will be cause for celebration. So let me know in the comments below how you think we should celebrate this milestone. I'm open to ideas. Anyway, switching gears and getting into my best and worst performers for the month. At the top here, the best performer, believe it or not, was Intel, who saw a 31% gain just in the last 30 days. And they jumped after their recent investor event where they announced really positive results for their data center chips, who apparently had more than 450 design wins. However, even after this jump, Intel is still by far one of my portfolio's worst performers. Taking a quick look at my position here, I have just about 63 shares of Intel at an average cost that is quite a bit above its current share price right here. So like I said, I'm still seeing a really big loss. And in total, I am down about 26.3% with my Intel position, which means I'm still seeing a loss of about $730.50. So that's not nothing. Anyway, moving on, Apple also saw a really nice jump in the last 30 days where they were up nearly 12%. And this company seemed like it had a lot going on in the month of March. In the news, they're considering bidding on the streaming rights for English Premier League games, and they also announced plans to spend more money on original entertainment content like new shows, movies, stuff like that. Also, they acquired a new AI startup called Wave 1 that is working on AI algorithms that can be used to compress videos to a file size that would essentially only be about half the size. So that's pretty exciting. And they also rolled out a new buy now, pay later option in the US called Apple Pay Later. But anyway, going back over here, Southern Company also saw a really nice jump, up 10.3% in the last 30 days, which is pretty surreal for this company. And then Procter & Gamble also saw a really solid gain, up 8%. And switching gears, taking a look at my worst performers, there was a few that really didn't do too well. Altria Group, WP Carey, Main Street Capital Corporation, ORCC all saw pretty big drops in the last month, but KRC is sitting here right at the top with the biggest loss, and they are down another 10% in the last month, and they're quickly becoming one of my portfolio portfolio's worst performing positions. So taking a quick look at my position, I have exactly 48 shares of KRC at an average cost just under $42, which as we can see here is kind of a similar situation as to what's going on with Intel up here. Actually really similar average costs and current share prices. But anyway, scrolling over here, taking a look at my loss with KRC, I'm down 22.5%, which means I'm seeing a $453 loss with KRC so far. However, unlike Intel, I've been adding more to my KRC position, and as you can see here, I picked up a few more shares in the last month. In total, I bought 6 shares, spent about $180 on these 6 shares, so not too bad. And with that, I also invested about $130 into Johnson & Johnson and picked up 0.85 shares of that, along with a pretty big contribution to Lowe's in the month of March, near $330, and got about 1.7 shares of Lowe's. And then the last individual stock I bought in the month of March was ORCC. I added 8 shares to my position and spent nearly $100 on that. And then last but not least, throughout the month of March, I contributed $250 to my Roth IRA, bringing my total purchases to just under $1,000 for the month. And now moving on, taking a quick look at my Roth IRA, just showing you guys a little bit what's going on in here. It's currently valued at just over $3,600, and in the last month, I was down about 1.25%, seeing about a $45 loss. And all time, I'm still down about 3.4% in this portfolio, down about $70, so nothing too crazy there. And so taking this Roth IRA that's valued at about $3,600 and is bringing in just over $100 of annual dividend income, and adding that to my main portfolio that is valued at $44,459 and is bringing in $1,973 of income. With these two portfolios combined, the total market value is just over $48,000, and in total, I am bringing in $2,081 of annual dividend income, which is nearly $175 every single month. So we're getting up there, guys. But anyway, switching gears and talking a little bit about my watch list, the stocks that I have my eye on. There was actually a lot of action in this watch list over the last month. One thing you guys will notice here this month compared to last month is I actually removed Kroger from this watch list. I was so hyped on this company for quite a while, and I was actually really close to starting a position in Kroger, but the more I thought about it, the more I felt that I was just going to be better off investing into companies that I already had in my portfolio, like Procter & Gamble and Coca-Cola, whose products are sold in Kroger's stores, as well as every other grocery store in existence. Plus, the grocery industry is extremely fragmented, and going up against other behemoths in this space like Target, Walmart, Costco, and Amazon just wasn't a battle I wanted to be a part of. But anyway, with this, guys, I added a few more companies to this watch list. One that has been on and off this list probably a few times now, but we'll get to that in a second. The first one I added here was Reliance Steel and Aluminum Company. And taking a quick look at their dividend stats here, there is a lot to love, I think. The yield isn't the highest. I mean, it's only about 1.5%, but look at that payout ratio, guys. The payout ratio is lower than the 5-year growth rate. That's pretty unbelievable. And they have a 5-year growth rate at 14.4%, so that's nice and high. They've been growing this bad boy for the last 12 straight years, so that's pretty exciting as well. But anyway, getting to Vici Properties, I added it back to my watch list because I really do think it's a solid REIT. And I figure, you know, as a Las Vegas resident, it'd almost be sacrilegious not to own this company. But anyway, guys, the last one I added to my watch list is Williams-Sonoma, who I'll be making a more in-depth video on here pretty soon, but I think it's a really strong company, and I also think it's at a really nice, attractive valuation right now. And real quick, just taking a look at their dividend stats, this forward dividend yield is sitting right under 3%, so that's really not bad. And they also have a low payout ratio, just under 20%, with a nice and high 5-year growth rate, near 15%, with a few more years of growth than what we saw with Reliance Steel. 16 straight years of dividend growth, so I do like to see that. But anyway, guys, if you want to learn about some more very attractively valued stocks, then check out this next video right over here, where I'm telling you about 4 that are just deeply discounted and all look like really good pickups right now in the month of April. So click right over here to check them out, and I'll see you in the next one.